You want to know what are the best stocks to buy now? I got you covered with 7 stocks I think are attractive to buy right here and lower. Well, first, let's address the elephant in the room, Nvidia, because everybody asks me every single day, is it still a buy? Should I buy Nvidia stock? The stock had a split, and anytime you see a split, you're going to see a run up and you're going to see a sell off. It happens every single time. $140.76 is the high it got to. And of course, what's crazy about this, guys, you look at year to date, it's still up 159%. In the past year, up 207%. And in the past 5 years, almost 3,000%. So Nvidia stock was down about 13% from its highs. Already got 6% of that back today, 5.87%. Back to a $3.07 trillion market cap. Growth is absolutely insane. A plus here in Seeking Alpha. Valuation, well, of course, this is where you get into the debate. Right now, the gap forward PE ratio is a 46.43. As long as earnings continue to deliver for Nvidia, the stock's probably going to go higher. I think that the valuation's probably going to stay roughly in these levels, but if earnings deliver, it's going to grow into that. The multiple's going to stay the same and the stock's probably going to go higher. And this is rocking a 75% gross profit margin, which is absolutely astounding when you think of a fabless semiconductor play. Of course, it has the software stack as well. And net income per employee, you'd be blown away by this, $1.44 million TTM, 12 months trailing per employee. Some of the stocks you guys are buying right now have negative net income per employee. You're talking about $1.44 million for Nvidia. Just to put that in perspective, Amazon is less than $25,000 per employee. You say, okay, well, Amazon's not a great example. Fine. Let's look at AMD, $42,000, almost $43,000 net income per employee. Now, that's not a reason to go buy the stock. It's just a staggering number that I wanted to share with you. So we do chart day every single week. Last week we did chart day. Here's what I said in yellow. Said it hit $140.76 above this R3, started to roll over. Pretty normal. Lots of profits to be taken. The stock could easily drop 20% and you shouldn't be shocked. We got 13% drop from that. And I circled this yellow circle and said it could come probably anywhere in this circle. And this is the area, if you're looking to add on a dip, this is probably where you dollar cost average. Now you can see that I'm making this video and of course the stock is ripping up today and now it's on the top side of that circle. And this is a difficult stock because to go and load up on this right here, you could argue there's quite a bit of risk baked into that, right? And you're above all the moving averages, you're still chasing, but I'd much rather have somebody nibble after a nice 13% healthy sell-off versus buying it above the R3 at $140 a share. But understand if you buy this stock here, if it misses earnings or something, you easily see another, 13% sell-off, maybe even 20 or 30% sell-off, and that's something that you have to accept if you're investing in Nvidia at these prices. We've been recommending Nvidia stock on this channel since it was $150 back then, which is $15 after the split. So $15 or less DCA. And we called it a must-own stock in every portfolio in 2022. So I'm still long. I have over 2,500 shares. And as the stock continues to go higher, I'll trim more.
And MongoDB is announcing the launch of its new AI applications program. This initiative bringing together major players in the AI industry to assist other companies in integrating generative AI into their applications. They're not alone.
All right, you heard what he said. Helping companies integrate generative AI into their business and into the business's applications, usually using proprietary data. That's what we're talking about when we think of phase 2, big data and ontology. And MongoDB fits the bill.
Increasingly, companies are partnering with AI technology to enhance their business. Dave Echeria is MongoDB's president and CEO. Good morning to you. It's nice to see you. This is about, in some ways, integrating with various models.
Well, I think this is the problem customers have is they're feeling overwhelmed. It seems like every week there's a new advancement. A couple of weeks ago, Mistral came out with their very low cost but high performing model. Before that, Anthropic. And then there's rumors that GPT-5 is around the corner. So everyone's waiting for what's going to come. And so the whole point of this program is to address customers feeling overwhelmed by essentially doing 3 things: coming out with a reference architecture for particular use cases, built-in integrations to reduce integration risk, and technical expertise to help customers really get started quickly. And we have all the hyperscalers as partners. We have Anthropic, Cohere, and a bunch of cutting-edge, tech companies focused on orchestration services, as well as fine-tuning services to really fine-tune models for particular use cases.
So we've been talking about phase one, the infrastructure, building out the LLMs. He's talking about large language models, and those are really powered by companies like Nvidia with the processing power. That's where the revenue is being generated right now. This is going to be a process and an evolution to get to the application layer. Companies like MongoDB, Snowflake, Palantir, Elastic, those are businesses that are going to help customers, enterprise, so businesses like Fortune 1000 companies, take their proprietary data and make better use of it by integrating their data into these LLMs, into generative AI models. This is really talking about enterprise generative AI.
Typically, when a new technology comes out, value accrues at the bottom layer first, right? You're seeing Nvidia post amazing numbers. Right. OpenAI has been the most talked about company since they introduced ChatGPT 18 months ago. But what we're seeing customers saying is that, when do I get the value? Where do I get the return? And the return will be coming through the applications that are built on top of that infrastructure. Right. And so we're now starting to see the build out of those applications, either consumer apps or now enterprises.
Okay, so what's a cool example of some apps that you think have some great value today?
Let me give you an example. We have an automotive company who's built an app that listens to the noise of your car. So if you're having a problem with your car, right, you can record the noise in your car and essentially get quick diagnosis of what the potential problem is, because they have this repository of all the potential issues your car may be having.
That's cool.
So that's an example of like using AI very intelligently to deliver a better customer experience. And so that's one example. We have other customers who are essentially using AI to figure out how to look at health reports and be able to provide better diagnosis for patients, so that they don't have to spend all this time trying to figure out what's wrong with them. And then we have two banks who are using our technology to radically reduce the time and cost of migrating off legacy platforms that are old, brittle, and expensive to new modern platforms. That's Bendigo Bank and Adelaide Bank in Australia, who are actually working with us to do this. So people are quite motivated to do this, but it's still very, very early days.
Now, if you're a person who struggles with the use cases and how you can actually use generative AI in a business setting, listen very carefully to this next piece.
In those instances, they're training off of the data from these enterprises, these individual enterprises. They're not just using the large language model to figure this out.
Well, there's a bunch of use cases. There's like customer support use cases where you can automate the interaction of service support. There's automation use cases, and then there's what people call enterprise RAG. And so enterprise RAG, or retrieval augmented generation, is you're marrying private data with the public data and reasoning of the models, right? So in that case of that automotive company, they have that private data of what all those noises sound like and what are the potential issues, but they can marry that private data with the public data to generate incredible value. And you're going to see a lot more enterprise RAG use cases being deployed, because data is the new gold, and people want to use their data for a compelling advantage.
Now, that clip should be really powerful to help you connect some dots here. These phase two data and ontology companies are helping businesses connect their data with generative AI, but not just using their own data, also having the ability to scrub that data, that proprietary data, versus public data to get better answers and better results. This is very powerful for businesses, and I really hope these videos help put that puzzle together. If content like this is helpful and you want to be a better investor, make sure you subscribe to this channel. So valuation metrics on Mongo, if you look at the cloud SaaS metric of EV NCM revenue, it's rocking about a 8.1x, which is pretty attractive here. It is just below that rule of 40 score. And when you look at history of free cash flow, you can see the numbers have dramatically improved. So we're heading in the right direction here for MongoDB. So looking at MongoDB's chart, now you saw after earnings, big sell-off, you've got a gap down. Oftentimes there's more pressure to fill that gap. Right now, the stock is trying to find some footing here on this S1 around $220 a share. The S2 is around $182.75. The S3 is about $120.89. So it's always tricky with these gap down scenarios. You could see more pressure. And I told the gang in Discord, don't be surprised if this stock gets below $200. That is a possibility. So I can see it in the 190s. I think it's a really strong buy there, but I am buying MongoDB $225 or less DCA. And I am buying MongoDB in both portfolios. In fact, in the main, I bought it in this area, $150 level, When it ripped up to $500 a share, I did trim it, but I do still have some shares at that lower cost basis, and I have been actually buying more shares, dollar cost averaging up. And we did start a new position in the community portfolio. It's actually green as of right now. One that's getting interesting here, guys, is Celsius. Now, we'll look at a chart here in a minute, but you might be surprised. I think if you ask somebody on the street, hey, what's the number 3 energy drink in the United States? I don't know if a lot of people would select Celsius as their answer, but it is in fact number 3. 6 new countries added in 2024, and you might be surprised as well, 20 years in operation. Celsius really brands itself as a premium brand, better ingredients. It's better for you than other energy drinks and zero sugar. Celsius contributed 47% of all energy drink category growth year over year in Q1 2024. Think about that stat just for a second. So a lot of people ask, and someone even asked in Discord, I think this morning, what's the big deal about Celsius? Now, you could easily make an argument that calling it proprietary blend is just really good marketing. Nonetheless, that's the reason why younger people are attracted to Celsius. And you can see on your screen some of the highlights. There's also 6 scientific studies backing their claims. Now, of course, as an investor, you have to take all this with a grain of salt. What we do know from an investing standpoint is that the energy market continues to grow when you think of energy drinks. And you can see the growth for Celsius has been staggering. Health and wellness trends driving zero sugar adoption. 28% of energy drink consumers aged 18 to 34 say better for you or natural ingredients are important in their purchase decision. You can see the global expansion here in orange. Also in the black, you've got markets with new Celsius sales and distribution for 2024. Celsius International sales grew 52% in FY 2023. If you look at market share here, Q1 2024, 11.4% behind Monster and Red Bull. These really are the 3 leaders. Everybody else here is fighting in that 3% range: Ghost, Rockstar, Reign, and so on. And of course, a lot of these are actually owned by Monster, so Monster does have significant market share. Monster recently bought Bang, they own Reign, and so on. But if you look at this growth here, 240.5 million. The only thing that's even close to that is Red Bull, and that's going to be at 80.2 million right here. In fact, Rockstar and Monster showed negative numbers. All right, so why is Celsius selling off? At one point, this was almost $100 a share, and this is one that did have a stock split, ripped up to almost $100. Now it's trading around $55 a share as I'm recording this video. So obviously, valuation is one reason. Loss of momentum is another. Anytime you have loss of momentum, usually there's some sort of macro catalyst like earnings, etc. Now, we did have a drop on the Nielsen data. It says here it was justified. So on May 15th, Morgan Stanley quoted the latest data, writing that Celsius suffered a small loss of market share. That's from 10.8% to 10.5%. This led to an unusually rapid sell-off. People thought, oh no, Celsius is doomed. They are no longer growing. And of course, with growth stocks, this is always the case with Wall Street. It's going to grow. As long as it keeps growing, as soon as that growth slows down, people get spooked, they take profits, they sell the stock off. And of course, it was priced for perfection as well. What are the metrics now? Well, it's certainly not a cheap stock by any means, even at $55.94. It does have a GAAP forward P ratio of 56. Now, that's certainly not cheap, but it does have tremendous growth. The forward price of sales is 8.24, the 12 months trailing 9.79. On that growth, though, 81%, you can see it is slowing down to 50%, but still very strong growth. And profitability, Seeking Alpha gives it A-. That gross profit margin is about 50%. So not at the software ratings of 80, 90%, but still pretty solid. And Celsius is bringing in $344,000 net income per employee, 12 months trailing. So we do chart day every single Wednesday, Patreon Discord. Last week, I believe it was last week, we looked at it. We've had this yellow circle here for quite a while as it started to sell off, saying, hey, this is the area I'd target. You can see that you are now in this yellow circle, and you're getting to that S3 around 54.31. So it certainly could bottom anytime. I would love to see it break the S3, get close to this trend line, and that would be somewhere in that $47 to $48 range. I do think this $55 area is an area to dollar cost average to add some shares, but it could go lower. Under $50 is strongly preferred, but $55, I still think it's attractive. And of course, keep in mind this stock has ripped. It was just in May of 2022, a couple years ago, it was $12 a share. And I do own this in both portfolios. My cost base is around $28 per share, but I would be willing to dollar cost average up if it comes down a little bit lower. So I've been talking about the different phases of AI and really breaking it down into infrastructure and then data and ontology phase 2, and then there's phase 3 and phase 4. Now ServiceNow, I have in phase 3, but really it's benefiting in phase 2. And truthfully, ServiceNow is benefiting from generative AI right now. And here are some of the things that businesses can do with AI. So when you think of ServiceNow, think of enterprises trying to leverage generative AI. And we talk about having to have clean data and connect that data to large language models and make it work for organizations, oftentimes with proprietary data. The Now platform includes generative AI, machine learning frameworks, natural language understanding, search and automation, and analytics and process mining that work together to seamlessly enhance employee abilities and customer experiences. And this is a good snapshot of what that looks like. You've got the machine learning frameworks, and you can see on your screen all the way down to data mining and analytics. So the Now platform brings the power of AI to an organization, delivering all the capabilities, security, analytics that people need to get work done faster, simpler, smarter, and so on. So it allows you to deliver and refine AI fast, supercharge productivity, protect and control enterprise data, and make smarter business decisions. This is a stock I've owned for a while. This is going to be a cloud SaaS. So this is going to have recurring revenue. And so you really do have to look at those cloud metrics. This is on my top 25 high conviction stock list. And we'll look at some financials and a chart. So the cloud SaaS metrics for ServiceNow. We've got an EV NTM revenue. The multiple is a 12.9x. Free cash flow, positive 33%. And that rule of 40, you want it 40 or more, is 58%. So very solid. Of course, when you look at a SaaS company with recurring revenue, a lot of them don't even have PE ratios. ServiceNow does, but it's going to be expensive because of that recurring revenue. The gap forward PE is 123. The TTM is a 79.16. This is according to Seeking Alpha. Growth is solid, about 22% for that forward revenue growth. And profitability, you're going to have some high gross profit margin because it's in software, close to 80%. And it is profitable, bringing in $85,000 net income per employee. Now, when you're looking at Wall Street analysts throw out price targets and things like that, if you see a write-up from Bank of America or Morgan Stanley or something, you're actually going to see, 54. This is a non-GAAP PE ratio. Now, preferably you want to use GAAP. But again, most software like SaaS companies like this don't have any PE ratio at all. And so even looking at this 54, it's a pretty solid number. Now, I did cover this recently on YouTube and said that I'd like to buy this 640 to 685, and it got down to 637.99. So if you're following the YouTube channel, you probably already bought ServiceNow. I do think it's in an uptrend though, and that this momentum could continue. In fact, this R3 is going to be closer to $840 per share, and it's trading right now at $751. I'm not buying it here. I've owned it for a number of years, and most of Discord was buying this $650 or less. And if you want an edge, you want to find opportunities like that, make sure you're subscribed to this channel, click the bell for notifications. And if you want to take your game to the next level, join us in Discord, head to patreon.com/firedupwealth, 7-day free trial, nothing to lose. I'm going to cover these next two stocks in rapid fire. We've covered these stocks several times on the channel, and if you want more information, definitely go to our homepage at Fired Up Wealth and check out some other videos. This first one is going to be a spec stock. So when we talk about spec, it's literally 10x or 0. This could be a home run ball, or it could go out of business. I'm going to follow up the spec stock with a high quality blue chip dividend stock that actually has a very attractive PE ratio. So hopefully something for everybody here. Navitas has tremendous growth, 100% forward, 57.6%. Of course, this is not profitable, doesn't have a PE ratio. It is burning cash. It does have a 7.73 forward price to sales. Not necessarily cheap, but is growing rapidly. The market cap, according to Seeking Alpha, is under $1 billion right now at $732 million. It's down 3% today at $3.88. This would be a spec play to hold 5 or more years. The stock certainly could go lower, $2.70 here on the R3. I think it's attractive, especially if it gets to $3.50 or less. If it gets under $3, it's going to be hard to ignore. I'm going to buy probably a ton more shares of this. But I do like this, anything in the threes as a DCA, thinking very long-term, 5 years or more. And remember, this is going to be burning cash, not profitable, interest rate sensitive. So you're going to need to have those interest rates come down before stocks like this are favorable. So you're really accumulating shares, thinking very long-term. And remember, this is a spec stock, so you can't go too heavy. I'll follow up Navitas spec stock with John Deere Green. Now, this is an A+ profitability. Of course, this is going to be an industrial. It's never going to be traded like a technology stock, but they are getting much more into that tech space, including hiring a CTO for the first time a couple years ago. This company's been around forever, getting more into autonomous tractors and drones and software, navigation, electric tractors. You get the idea. Again, it's never going to be considered a tech company per se, but forward gap right now, PE ratio 14.83, the TTM's 11.36. It does pay about a 1.5% dividend, and this is a company that you're just going to hold as a compounder. It's not necessarily going to make you wealthy, gives you some nice diversification in the portfolio, and I think this stock, especially if it gets any lower, is pretty attractive here. You're talking about a PE ratio right now, again, that 11.36, and the forward is about a 14.83. Now, my preference on John Deere forever has been $350 or less DCA. It doesn't seem like it wants to happen, and we do have this trend line. You can see it's bounced nicely. It did break it a little bit here, but you got $362 bounced off that. It's pulling back. If this gets to 350 or less, that's where I really like the stock, but I think it's attractive at, $365 where it's at right now. The S2 is 351, the S3 is 330. If it got down below $350 in these levels, I would be buying this stock heavily. Again, it's not going to make you rich. It's a nice little compounder, DGIF, add some diversity to your portfolio, and I think there's a lot of future opportunity with a company like John Deere.
So I think that the announcement today is really game-changing. I'm so happy that you did it, that Snowflake drove this innovation, and I think this is completely game-changing.
Is Snowflake stock going to keep melting? I just did a 30-minute video, a deep dive on Snowflake and its partnership with Nvidia. And that video has gotten over 60,000 views in a week. It's done very well, and you can go check that video out after this one's over. But I do want to share the financial metrics and a chart on this video because I do think it's a stock that's attractive to buy right now. In fact, this is the stock that I've been buying most heavily in my portfolios. So what is the valuation of Snowflake right now? So the current EV NTM revenue, this is a multiple that we generally look at for cloud and SaaS. Remember that Snowflake is consumption-based, but we still compare it to these peers. 10.8x. And remember, this was over an 80 EV NTM revenue back in February of 2021. This is a better company now with better numbers and way more products and opportunities, especially with generative AI. Rule of 40, 60%. Free cash flow, positive 27%. And the net dollar retention, 128%. Overall, these numbers are very solid. So is this an early Christmas present from Santa Claus, or is the stock headed lower? The reality, of course, any stock can always go lower. Right now, it's finding buyers on this S2 at $124.43. Now, the S3 is about $111. And if you draw a line back to a previous low in 2022, you'll see that's a retest from almost exactly 2 years ago, June of 2022. So it's certainly possible that it could come down to this S3 and retest that number. I think there's a better chance that it's going to find buyers before then, but it could bottom really any time in here. When I'm thinking of a 5-year investment to buy and hold and monitor, Snowflake definitely fits the bill. It benefits from generative AI in the phase 2 with data and ontology, and I'm buying this in both portfolios, $125 or less DCA. If content like this is helpful and you want to be a better investor, make sure you subscribe to this channel and click that bell for notifications so you don't miss a thing.